Hey, welcome to AI Book Summary. We're so glad you're here. We've got new content dropping all the time, so if you haven't yet, make sure to subscribe to the channel. Today, we're diving into an absolute classic, Benjamin Graham's The Intelligent Investor. This is the book Warren Buffett says is, by far, the best book on investing ever written. So let's explore that timeless wisdom together.
Here's what we're going to cover. First, we'll redefine what it even means to be an intelligent investor. Then we'll get into the huge difference between an investor and a speculator. After that, we'll help you figure out which investing path is the right one for you, how to handle the market's crazy mood swings, and finally, we'll lock in on the 5 critical things you can actually control. All right, let's jump right in.
So, first up, let's just throw a common assumption right out the window, the one about what it takes to be a successful investor. You know, it might not be what you think at all.
When you hear that phrase, the intelligent investor, what's the first thing that pops into your head? Some kind of super genius with a PhD in math? Or maybe someone who can just magically predict where the market's headed? Well, Benjamin Graham argues it's something completely different.
And this is where things get really interesting. Graham's whole idea of intelligence isn't about raw intellect, it's about temperament. It's about having the emotional control, the discipline, and the patience to stick to your plan, even when the rest of the world is going crazy. I mean, think about this. Sir Isaac Newton, literally one of the smartest people who ever lived, lost an absolute fortune in the stock market. How? Well, he got in early, made a nice profit, but then that fear of missing out, FOMO, it kicked in. He saw his friends getting rich, jumped back in at the very top, and lost everything. He famously said he could calculate the motions of heavenly bodies, but not the madness of men. So this whole idea of temperament and discipline, it leads you to a really fundamental choice that every single person has to make when they enter the market. And believe me, getting this choice right is absolutely critical.
Graham gives us a super clear 3-part test to figure out if you're truly investing. It's not about what you buy, it's about how you buy it. It means you've done your homework, you're focused on not losing money, and you're looking for good, solid returns, not lottery ticket winnings.
So you have to ask yourself, what's my identity here? Am I acting like a business owner, carefully analyzing a company for its long-term value? Or am I just acting like a gambler in a casino, chasing a hot tip and a gut feeling? Because one of those makes money for you, and the other, well, it mostly just makes money for your broker. And this story just shows how completely mindless speculation can be. Back when Ticketmaster went public, the hype was so intense that investors started pouring money into a totally different company just because its ticker symbol was similar. People were just clicking buy without a second of thought. That right there is pure speculation.
Okay, so once you've made that commitment, once you've said, yep, I am an investor, not a gambler, what's next? Well, you've got to choose your path. And Graham argues this choice has nothing to do with your age. It has everything to do with your personality.
Graham basically lays out 2 main paths. You've got the defensive investor who wants simplicity, safety, and freedom from constantly worrying about it. Then you have the enterprising investor who's willing to put in the time and the work to try and get better returns. And listen, neither one is better than the other. What's important is picking the strategy that actually fits you. He also just completely throws out those simplistic, one-size-fits-all rules, like subtracting your age from 100 to figure out your stocks. He says your real-life situation is what matters. His approach is way more thoughtful, with a core rule of always keeping at least 25% in bonds for stability, and get this, only checking in twice a year so you don't make emotional mistakes. Now check this out. Take Mrs. Smith. According to those old, age-based rules, she should barely have any money in stocks. But look at her situation. Her finances are rock solid. She's got a pension, tons of savings. She can absolutely afford to take on more risk to grow that money for her family. And then you've got John on the other side of the coin. Yeah, he's young, but he has huge near-term goals. A wedding, a house, things he needs that money to be safe for. For him, a much more conservative portfolio makes total sense. See? It's about your life and your responsibilities, not just your birthday. All right, now we get to the big one. This is probably the toughest challenge for any investor. How to deal with the wild, emotional, and often completely irrational behavior of the market itself, which Graham famously calls Mr. Market. So what does Graham say you should do about all the crazy daily swings? His advice is bold, simple, and for a lot of people, almost impossible to follow. You just ignore them. Tune out the noise, because those day-to-day price moves are just a reflection of crowd psychology, of fear and greed, not the real, underlying value of the business you own. Let me give you a perfect example. The story of a company called Inktoy. During the dot-com bubble, its stock price went up by an unbelievable 1,900%. That surge had almost nothing to do with how the actual business was growing. The hype was completely disconnected from reality.
At its absolute peak, the market was so euphoric, so optimistic, that it valued this company at a mind-boggling $25 billion. Just an incredible number built on nothing but pure hope.
And here's the crazy part, the big catch. The company had never made a single dime of profit. In fact, it was losing millions consistently. So what happened? When the market's mood inevitably swung from wild optimism to deep pessimism, the stock completely collapsed. The business didn't really change, just the crowd's opinion of it.
And this all leads to one of Graham's most famous, most powerful lines of advice. You should use the market's mood swings as your opportunity. When everyone else is pessimistic and scared, that's your chance to buy. And when everyone is euphoric and optimistic, well, that might be a good time to sell.
So, if you can't control the market's mood, and you certainly can't predict its next move, what should you be focusing on? Well, that brings us to our final and maybe most important takeaway from Graham's work.
Graham boils it all down to these 5 critical things. The 5 things that are actually 100% within your power. You control your own expectations, the amount of risk you take on, what you pay in costs and taxes, and the big one, your own behavior.
And out of all of those, your behavior stands head and shoulders above the rest. It's your ability to stay disciplined when everyone else is panicking, to think for yourself when the herd is stampeding, and to truly maintain a long-term outlook that is the single biggest factor in your success.
In the end, what Graham teaches us is that your success as an investor really doesn't depend on what the market does. It depends on how you react to what the market does. The market will always have mood swings. The real question is, will you? Thanks so much for tuning in. If you got something out of this, please give us a like and share your thoughts in the comments below. We'd love to hear from you.